Despite all the problems here, longer-term U.S. Treasuries, we should point out, have remained attractive, even in Britain, where riots, you've heard about this, we showed you last night, in the past couple of nights, have dominated the headlines. British government notes have held steady. So is it a safe bet, long-term, to be in government debt? We ask Ron Davari, he's CEO of NewOak Capital. And listen, you advise about $3.4 trillion, about three quarters of $1 trillion of other people's money. Are you advising them to go into things like British bonds, even as riots course the
Well,
states?
you know, if 10 years ago somebody said you should be in U.S. Treasuries, people would have said, well, we're already past 9/11, blah, blah, blah. If you had invested in a 10-year Treasury fund since then, you would have actually doubled your money. And if you had invested in stocks, you essentially would be flat today. So it's very difficult to predict whether the stocks on a long-term basis are going to go up. So I think it's more of, as people are now, as a matter of fact, paying to own Treasury, because Treasuries are, the 2-year Treasury right now is only paying 17 basis points. So the value of that Treasury is really a hedge against this turbulence that we have seen. So for people to even park their money, they have to pay. It's like you're parking your car. You have to put the money in the meter, and that's what people are not used to. But I don't think that's the view you should have about bonds. Bonds are actually very interesting instruments. They should be part of your core portfolio. There are a lot of pundits that actually a year ago they said the yields have to go up. But you know, what percentage of those folks were actually right, even as early as 3 months ago?
Well, on a day like today, where we lost more than 500 points on the stock market, how do you feel about equities?
Well, you know, you should always buy on the dips, and you should always be diversified. So as an asset class, you can always allocate and then gradually allocate a little bit and move your allocations. Right now, I think you probably would want to tilt your allocation toward equity, but a global diversified equity. And you know, not just on the U.S. stocks, but also think of some of the Asian stocks, Asian bonds. You mentioned currencies. Currencies, I don't believe currencies are themselves an asset class, but owning entities that grow in those countries, and you're exposed to the economies of those countries, not just through the currency itself, but through a portfolio that is not really hedged to just one currency, because people should not really look at the portfolios that way.
Are you alarmed? How could you not be by all that we've seen over the past couple of days? We've had several days of 400-point swings. I look at that, and it's highly unusual. But let's remember that back during 2008, when the TARP vote didn't pass, the market fell 777 points. We haven't quite seen that yet. It's just that we're getting awfully close to bear market territory. You're still very copacetic and calm, saying, should be buying on the dips here. How do you pick what you're going to buy, though? It really
comes down to your horizon. You shouldn't be watching the market every day, but you know, given that maybe 6 months ago you should have been lighter on equities and more weighted toward bonds, given that you already knew there are structural issues in the U.S., there are structural issues in Europe, and there is also a shift going on from growth moving from the U.S. to the rest of the world. So with that in mind, if you had diversified your positions, you would have been much better and you would have been calmer today.
We can't ignore this issue, that there is a political element to all of this.